The traditional model for making money is broken.
Why are we punishing people for doing the right thing and getting an education?
ChatGPT.
Well, as ChatGPT grows its resume, it could very well come after your job.
Since 1979, all that changed. Productivity has grown 4 times faster than pay has grown. You work hard and contribute to the success of enterprise, you get to share in success. That's not the case anymore.
The plan goes like this. You study, start a career, climb the ladder, and make lots of money. But these days, this cast iron idea is in bits. Rising universe debt is making the return on investment from studying more unpredictable. The more you pay, the more you have to earn to make it worth it. On top of this, real wages, which is your salary after taking inflation into account, is stagnating. The majority of people share in economic growth through the wages they receive for their labor and nothing more. So stagnation of real wages means that though the economy has been growing, the primary way most people benefit from that growth has almost completely stalled. For example, since the early 1970s in the US, the hourly inflation adjusted wages received by the typical worker have barely risen at all, while in the UK, real pay growth has been stagnating for the past 20 years. When you add to this the rise in temporary work contracts, which make long-term job security a thing of the past, what you're left with is a broken system. And naturally, people are trying to escape this broken system and find other ways to make money.
Short interest in GameStop.
This GameStop
story of GameStop. What's going on Reddit and TikTok is really fascinating.
A little more than a week ago, the short interest in this stock exceeded the number of shares outstanding.
NFTs.
NFT.
What are NFTs? And why are people trying to get rich off them?
Well, I have never said that people should invest in crypto.
Crypto assets being valued at the end of 22 at roughly $1 trillion.
Investing has always been a great way to build wealth. The US National Study of Millionaires shows that the vast majority of millionaires are engineers, accountants, and teachers, and the vast majority of them did not inherit their wealth. They got wealthy by investing. But not all investments are created equal. Some come with much greater risk than others. And over recent years, high levels of financial illiteracy in society, combined with high levels of desperation to escape this broken system, has fueled risky investing. People have hopped on new social media-based investment trends, engaged in very risky investment strategies, and even relied on some moral high ground over established players as a working strategy to make more money. Now, I have nothing against crypto, NFTs, or socially organized investing, but at the same time, I'm aware that the current hype around these new asset classes is distracting people from a once-in-a-lifetime opportunity in the traditional asset classes. I want to bring your attention to a simple and timely investment strategy that's available to you right now, relatively easy to understand, and historically has proven to build significant wealth. I want to help you solve the wealth puzzle. The stock market is a wealth-building machine. Throughout history, the stock market has always had a shining allure, the place where fortunes are made and lost, where winners turn into losers and losers into winners, seemingly on a daily basis. Over the years, it's been glorified in movies and vilified in the news. But since its inception, one thing remains absolutely true. It has enabled anyone with access to it to build extraordinary wealth over time. Initially, the opportunity to own a piece of the economy was only for the wealthy and extremely privileged. But over the decades, the stock market has gone through waves of democratization. For example, in the 1920s, the introduction of margin investing enabled average people to get a bigger slice of the action. With margin investing, investors were able to borrow cash from banks and then use this extra cash to buy more stock than they could afford. This practice enabled novice investors to leverage their position, thereby giving them earning opportunities previously only available to investors much wealthier than them. This is just one of the many waves of democratization that have occurred throughout the years. Others include the go-go mutual fund era in the 1960s, which lured anyone with a few $100s into the market. There was also the US government's deregulation of fixed commission charges on Wall Street in 1975, which made it much cheaper for individuals to buy stocks. And of course, the combination of discount brokers and online trading in the 1990s, which up to now is probably the change that had the greatest impact in bringing investing from Wall Street to Main Street. But this wasn't the end of democratization in the stock market. In fact, in some ways, it was just the beginning. Enter Robinhood.
Robinhood at prices tonight begins trading tomorrow.
From the very beginning, our mission has been to democratize the financial system.
And we've talked a lot about your efforts to democratize investing for an entire generation, really for the first time.
We believe that the more people that have access to the markets and can start investing earlier, the better off our economy will be.
Robinhood is here to stay.
If you've been living under a rock for the last few years, you might not have heard of Robinhood. They're a financial services company that facilitates commission-free trades of stocks and other assets via a phone application. The company launched in 2015 with the aim of democratizing investing. And in their time to shine came when, due to lockdown, people were bored at home with cash to spare. There are a lot of question marks surrounding Robinhood, just like the bucket shops back in the roaring 20s. But unquestionably, the company has brought about a new wave of democratization that has opened up the stock market to the masses. But how did Robinhood do this exactly? Well, they did it in 3 ways. First of all, they eliminated the cost of buying a stock, making investing practically free. If fees are not an obstacle, they are at least a deterrent to many would-be investors, so their eradication removes the barrier to entry for many. Secondly, they put investing on your phone. This had a two-pronged effect. It made investing much more convenient, and it increased its exposure to younger people who are often left out of this wealth-building opportunity. Finally, and maybe most importantly, they popularized the buying and selling of fractional shares. Some stocks are very expensive, with market prices in the hundreds of dollars. This makes buying one share in these companies not affordable for everyone. But through the process of fractional shares, it's possible to buy a percentage or a fraction of one share, meaning anyone with just a couple of dollars can own a tiny part of any company. These new changes brought about by Robinhood and other fintech companies offering similar services, along with, of course, the changes that happened throughout history, means that right now, at this moment, anyone with an internet connection and just a couple of dollars can own a piece of any company. Today, all of us have access to this wealth-building opportunity in a way that our ancestors could only dream of. However, as important as this unprecedented access to the stock market is, it is only one part of the solution to the wealth-building puzzle. The next part, which might be the most vital part, comes in the answer to the question on everyone's lips. How do you actually make money in the stock market?
Here's the stock market.
NASDAQ, S&Ps,
the Nikkei 225,
the NASDAQ rebalance,
the New York Stock Exchange.
What is the reason the stock should be higher?
Pick your poison.
Countdown to the open starts right now.
The goal of investing in the stock market is to buy low and sell high. But it's not that easy. Estimating the value of a company is complex and it involves a lot of subjective predictive measures. It's as much an art as it is in science. Institutional investors create algorithms and metrics and reports in a bid to accurately estimate the fair value of a company. These subjective values then act as buying signals. For example, there is potential buying opportunity if the current market price of a stock is below its estimated value, because if this value prediction is correct, then the current price will rise up towards it. Whereas if the current market price is above this estimated value, it's not a buying opportunity. The one thing we can learn from this is that price and value are not the same. Value is what an investor deems a stock to be worth and is therefore subjective, whereas price is the amount of money an investor is willing to pay right now for the stock and is therefore objective. This separation of price and value is what drives supply and demand in the stock market. So when we say the goal of any investor is to buy low and sell high, what we really mean, and this is important, is that the goal of any investor is to buy a stock whose current price is lower than its current estimated value. All speculators in the stock market are like prospectors panning for gold in the hope of finding treasure. Every second of the day, they're calculating, analyzing, and searching for opportunities. The problem is, it turns out, is that they're not very good at it. According to Spiva, which is an independent research firm that measures the performance of actively managed funds worldwide, most active managers underperform the market most of the time. Simply put, it seems that the vast majority of the time, these funds can't pick stocks that have a higher estimated value than their current share price. One of the most famous and successful investors of all time, Philip Arthur Fisher, said it best when he stated, "The stock market is filled with people who know the price of everything and the value of nothing." So if these institutions can't do it with their limited resources, knowledge, and talent, how can you?
A lot of the world's going into recession. The Eurozone's in recession.
We're playing with fire here.
I still think that we're going towards a recession.
Germany is in recession.
According to a new Reuters Ipsos poll, the economy remains the top concern for Americans.
We've got a real crisis coming here. I cannot predict the future, but this recession is so expected, so predicted. Maybe it's coming. I don't know.
Now, depending on your perspective, history is either plagued or blessed by stock market crashes. For some, they are a devastating economic shock that dramatically erase wealth, while for others, they are a unique once-in-a-lifetime wealth-building opportunity. During a stock market downturn, prices fall, but values don't necessarily fall with them. These metrics that I touched on earlier, which are used to calculate the fair value of a company, include questions like, how much cash does the company have on deposit? What is the value of the assets the company owns? How much debt is it carrying? The answers to these questions and many more don't necessarily change just because the share price falls. In fact, typically market crashes are the result of difficult to predict poor macroeconomic conditions which lead to a fall in demand for the stock, not a fall in the value of the company. This has been proven time and time again throughout history, as after every stock market crash anywhere in the world, prices have rallied back up to their pre-crash values and then onto all-time highs. Unfortunately, many treat stock prices as a performance indicator. So when prices are down, the signal to them is that it's a bad time to buy. But prices aren't a performance indicator, they just reflect demand. Buying stocks when prices are relatively low is a fundamental part of successful investing, and it's likely that anytime prices are low, demand will be too. So the answer to the question, how do you make money in the stock market? Well, you buy stocks that are worth more than they're currently selling for. And luckily, a market downturn, just like the one we're experiencing right now, naturally gives you the opportunity to do just that. The recent complete democratization of the stock market, combined with the current market downturn, offers anyone with cash to spare a unique, once-in-a-lifetime wealth-building opportunity. However, there is one final piece to this wealth-building puzzle.
Explanation cannot be found in any mathematics, but it has to be found in investor psychology.
Put your money away, month after month after month after month, and don't look.
40-fold since World War II, stock market's up 40-fold.
And a short focus is not conducive to long profits.
And so a dividend-paying investment would typically be large company stocks that are paying out their profits.
High dividend stocks would be an area of concentration at the start of the year.
Reinvesting your dividends can have a huge impact on your long-term results, dividends. And it's a question that seems basic on the surface, but I think is one a lot of investors probably don't put enough thought into.
In order to increase your probabilities in the stock market, you need to understand the factors that have an impact on your return and your risk. Let's first look at return. When you buy stocks, you make money in two ways: capital appreciation, which is when the stock price rises, and dividend, which is paid as income when the company redistributes a portion of its profits to shareholders. When it comes to investors' total return, the role of dividend is often largely underappreciated. Let's take the most popular market out there, the S&P 500. This is an index which contains the 500 largest companies in the US. Without taking dividend into consideration and just stock price, a $10,000 investment in the S&P 500 in 1960 would have been worth over $795,000 at the end of 2021. If you look at the S&P 500's total return from 1960 to 2021, with reinvested dividends included, a $10,000 investment would be worth just under $5 million. This is a 6x difference in total returns, and it's earned by simply reinvesting dividend payments back into buying more of the same stock. In fact, over the past 60 years or so, reinvested dividends and compound earnings accounted for 84% of the S&P 500's total return. But this is not an isolated example. Similar results can be seen across different markets over different time periods across the globe. These seemingly small additional purchases of stock on a quarterly basis compound to have a huge exponential impact over time. It's safe to say that consistently reinvesting your dividend payments is the least talked about investment strategy that can explode your returns. But where there's return, there is risk. Managing risk is a simple part of any investment strategy, and it can be as simple or as difficult as you want it to be. The most basic yet most effective risk management strategy is to invest over the long term rather than the short term. Short-term investing statistically carries much greater risk than long-term investing because the longer the time horizon, the narrower the range of outcomes. Again, using the S&P 500 as an example, over the past 100 years, investing for 1 to 10 years carries significantly more risk than investing for 10 to 30 years. In fact, at any point in the last 100 years, investing for over a 15-year period would have practically guaranteed you a return, and over a 30-year period would have guaranteed you a minimum of 8% return. Simply speaking, investing for the long term significantly reduces risk, which leads to less erosion of profits over time. Investing for the long term isn't always easy because it takes abilities most people don't have, namely delaying gratification and staying calm during falling markets. Generally speaking, those who reinvest their dividends and possess the temperament to be patient and resilient over long term have a huge advantage when it comes to building wealth. There's no question about it, we're currently living in economically uncertain times. We feel this day to day when we do the weekly shop, pay rent, buy clothes, and on top of that, try to save a little. The allure of quick money is nothing new, and it's a trap we can all fall into, especially when times are tough or uncertain. We want what we want right now, and we don't want to work for it or wait for it. Social media exacerbates this weakness in the human condition. I say weakness because we all know that anything of value in our lives comes from a combination of hard work and patience. Personally, I believe in the long-term value of the crypto and NFT markets, and I think that social media investing will be around for some time to come in some way or another. However, at the same time, I know these markets are new and unproven and come with huge levels of risk, especially considering the vast majority of promotion is around short-term gains. This hype and short-termism makes building wealth seem like a complex problem to solve. But it's really not that difficult, and right now, in this very moment, it's maybe easier than ever. Though you are living through a time of uncertainty, you're also living through a time of great opportunity. You only have to focus on it to see it. The recent and complete democratization of the stock market means that you, for just a couple of dollars, can own a piece of the largest companies in the history of the world. You're also well placed to take advantage of the huge buying opportunity currently on offer in the stock market, as prices are low and could continue to fall. On top of this, you're now armed with the knowledge you need to maximize your returns through dividend reinvestment and minimize your risk through long-term investment. Time and time again, people know the right moves to make, but out of fear and greed, they make the wrong ones. Investing isn't taking on as much risk as possible or avoiding risk at all costs. Either of these will probably see you end up broke. It's taking on risk, managing it, and controlling it. I've just laid out a timely, statistically proven solution to the wealth building puzzle that does just that. A plan that dramatically increases your returns while massively reducing your risk compared to other current touted investment strategies. It's the right move versus the wrong move all over again. Don't let fear or greed stop you from taking it. Start building your wealth faster right now.